Hello and welcome to the MSU Wealth Management Association podcast. My name is Brandon Klump and I'll be your host for today. Joining us is the legendary Ric Edelman, a very influential figure in personal finance and wealth management space. Ric is the founder of Edelman Financial Engines, the nation's largest RIA firm, which serves over 1.3 million clients and manages over $300 billion in assets under management. He's also a New York Times #1 best-selling author. Beyond these accomplishments, Ric is a pioneer in the digital asset space, having created the Certified in Blockchain and Digital Assets, or CBDA designation. He's the creator of The Truth About Your Future, a platform focused on educating consumers and investors about finance topics, digital assets, and more. Today we'll dive into Ric's invaluable career advice for aspiring wealth managers, practical tips on building strong client relationships, and strategies for earning trust early in your career. In addition, we dive into the evolving role of cryptocurrencies in investment portfolios. We hope you enjoy.
Okay. Hey, Ric, it's a pleasure to have you on our podcast. You've been, a role model and mentor to me and to so many in this industry, and we appreciate you giving us some of your time today.
It's my pleasure to be with you, Brandon. Thanks for the invitation.
So jumping right into the first question, what advice would you give to students or recent graduates about navigating the beginning of their career in wealth management?
Well, you have to decide what path you want to take. There are two primary choices. You can either manage money or you can manage clients. The two are separate and distinct. A lot of people make the mistake of thinking they can do both, and you really can't because they're both full-time jobs. Managing the money is the role of asset managers, money managers, portfolio managers, security analysts. These are the folks who generally have the CFA designation, Chartered Financial Analyst. These are the people who are hired by Wall Street, brokerage firms, investment banks, pension funds, endowments, hedge funds, other institutional investors, everybody from insurance companies to sovereign wealth funds. And these are the folks who are managing the money on behalf of the owners of that money. Mutual funds and ETFs are probably the best known of these asset managers because they're at the retail level. And so people see them all the time. Managing the money is a full-time occupation because you are given a charter on the style that you're going to manage the money under. Are you going to invest in stocks or bonds? And if you're going to invest in stocks, what kind of stocks? Growth stocks, value stocks? Or are you going to invest in large cap, mid cap, small cap, US or international? If you're going to manage bonds, what kind of bonds? Government or corporate? Are you going to manage short-term, long-term, intermediate term, high quality or high yield, US or foreign? So within the world of asset management, and I've only mentioned stocks and bonds, I didn't even mention real estate or commodities or crypto, you have to decide how you're going to manage that money, and then you're going to have to get into very deep security analysis to determine which securities you're going to buy and when you're going to sell them and in what combination. What's the asset allocation going to be like? So that's a very, as you can imagine, very detailed activity of managing the money. The people who are managing that money, those CFAs, have no idea whose money it is they're managing. In other words, if you invest in a mutual fund or an ETF, and you send you open an account at Schwab, and you send your money to Schwab, and you have Schwab buy in your brokerage account an ETF, the manager of that ETF has no idea who you are. They don't really want to know. You've hired them to manage the money, and that's what they're going to do, manage the money. Their goal is to generate the best returns they possibly can. Some of them are trying to manage the best returns relative to the risk that they're taking, risk-managed results. Others are just going to manage the money with an eye toward matching an index. They want to replicate the market rather than beat the market. But regardless of how they're doing what they're doing, they have no idea who they're doing it for. They know that somebody is the owner of that money, but they don't know who it is. On the other side of the fence are those in our industry who, rather than managing the money, manage the client. What I mean by that is financial planners, investment advisors, stockbrokers, and insurance agents. These folks have a direct relationship with the individual client. And it's through that client relationship that we are making the determination of where the client ought to invest their money. And rather than telling them what stocks and bonds they ought to be buying, we're going to tell them to give their money to those funds and let those fund managers manage the money for them. So as a financial planner, I'm going to build a portfolio of ETFs. Maybe I'll add mutual funds or annuities or real estate investments or hedge funds or other products. But I'm going to delegate the actual asset management to those fund companies and those fund managers and let them manage the money. So I'm going to take my client's money, toss it over the fence to allow those asset managers to actually manage the money. Meaning, I'm not managing the money myself. I'm managing the portfolio. I'm managing the asset allocation. I'm helping my client understand how we ought to allocate the money, how much of it should be in stocks versus bonds versus real estate, gold, oil, crypto, et cetera. But once we make that allocation decision, we're then going to hire the fund managers to actually buy those investments for us. And I'm going to work with my client on managing that portfolio, rebalancing, dollar cost averaging, tax loss harvesting. And I'm going to do all of this within the context of the client, meaning what are their goals? What are their objectives? How soon do they need access to the money? What's their need for liquidity? Most importantly, what's their risk tolerance? Because if I give them portfolios filled with risky investments and when those go down, the client sells in a panic, I didn't do anybody any good. So I want to give them an investment portfolio that they're going to be able to hold on to long enough to achieve the goals that we've laid out, whether those goals are saving for college for a child or buying a home for themselves or preparing for their own retirement or caring for an aging parent. Whatever the goals may be, we want to make sure that we're creating a portfolio designed for those goals within the context of the client's life, given their age, their income, their debts, their careers, their family dynamics, and all of the other metrics. So we're going to manage the client rather than managing the money. For example, if you talk to a money manager for an hour, they're going to talk about the portfolio for an hour. It's all they're going to talk about is the money they're managing, their outlook on the market, both macroeconomic and microeconomic. You talk to a financial planner for an hour, we're going to talk about the investments for about 5 minutes. The rest of the hour is going to be talking about the client. What's going on in your life? What's new? What's different? What's changed? To make sure that the advice I gave you last time we met is still valid today. And if it's not, let's figure out what changes we need to make. So you need to choose. Are you going to manage the money or are you going to manage the client? I remember once having a conversation with a money manager and describing for her the clients that I had recommended for her fund. And she was aghast. She said, "Oh my, don't do that." And I said, "What's the matter?" And she said, "You're putting a face on the money." That made it human. That made it real. It made her realize that the decisions she was making were affecting people's lives. She'd rather play with her spreadsheets than deal with the human element of money management. And that's the difference. There's not a good or bad, not pro or con. You just have to choose which you prefer. Do you want to be buried in your analysis and play with spreadsheets and numbers and the markets? Or do you want to spend your time with people and their lives? Two different career paths. You've got to choose.
Great. Now, just to throw in another question, I believe some students think that when you start in this career, you have to just start as like a new analyst. Going on the people side is hard because that takes, experience and trust, and you have to build that with age and knowledge. Is that true? Or can individuals who are younger, like ourselves, get into the people side, advising side at an earlier age?
You can. I mentioned the CFA designation on the money management side. On the people side, it's the CFP, the Certified Financial Planner. There are actually about 200 or 300 professional designations. Over my career, I've had, 7 or 8 of them. And so each of these different designations focus on a specific element of the industry, giving you the depth of knowledge and information you need to do what it is you're trying to do. But the two big boys in the business, so to speak, are the CFA for money management, the CFP for client management. So if you're going to go on the client management side, frankly, either side, the investment management or the client management, you can do either one in similar ways. You can follow one of two paths within these subsets. The first, the more traditional approach, well, I don't know if traditional is the right word. I would say the more common approach these days. Wasn't true when I got started back in the 1980s. I'm dating myself. My wife and I founded our practice in 1986. Brandon, you weren't alive. Um, when we got started, it was a very different world. Today, most college graduates join a large firm. That wasn't an option for me and Gene because there weren't any firms in our industry. We invented the financial planning industry. I was among that first generation, and there were maybe a dozen of us who invented this field. And so we didn't have the option of joining a firm because the firms didn't exist. It's the old story that Abe Lincoln taught himself law by reading law books. He didn't go to a law firm. Today, you got to go to a law firm. You want to be a lawyer. It's kind of how the financial planning field's evolved. When we got started, there was no degree in financial planning like you're undertaking. Uh, Everybody in the industry went to work either as a stockbroker or an insurance agent, which meant you were selling products. You were either selling stocks and bonds or mutual funds, or you were selling insurance products. And we felt that was distasteful because it wasn't necessarily in our client's best interest. We wanted to provide services for the client based on the client's need, and that's why we invented the financial planning industry, to focus on the client rather than the product. But by starting our firm on our own, I was 28 years old, we were able to begin instantly serving clients. I just simply had to persuade people to become a client, which remains today the number one challenge of all advisors, finding clients. Most are pretty good at serving clients. The challenge is finding them. You can't serve them until you find them. So we had the opportunity from day one to serve clients right out at the get-go. And today that opportunity still exists. If you go to work for a major brokerage firm or insurance company, they will give you a few weeks of training. They will facilitate you getting your licenses that are needed for you to participate in this industry. And then they will unleash you. And you can, within weeks, begin looking for and serving clients. I'm not convinced that that is necessarily in the best interests of the clients you find, because you're brand new. You have no experience doing this. So are you sure you're good at this? You sure that the services you're going to provide, the advice you're going to give is as good as the advice I would give, having done this for 35, 40 years? So yeah, you can pursue that path. I think most college grads are intimidated by that notion. They recognize their own limitations and experience. They'd rather develop the experience. And so the alternative, instead of joining one of those big brokerage firms or insurance companies where they will not only allow you, but expect you to start finding clients and generating business, you can instead go to other kinds of firms, such as RIAs, registered investment advisors, independent financial planning and investment companies, such as the one that my wife and I created, which is now the industry's largest. And you can get hired there as an assistant or as an associate or as an analyst working for a financial advisor in the firm. This will help you get your foot in the door early because they're not expecting you to have experience. And it will give you the exposure, which will provide you the experience you need, the mentoring from your advisor to grow and develop in your career. And over the next few years, you'll be able to grow into becoming that advisor who then serves clients directly. This is how most firms do it these days. They hire people and groom them, grow them in their careers. And this is also true with the big brokerage firms, banks, and even some of the insurance companies, where you could go to Merrill Lynch and become a broker day one, or you could go to Merrill Lynch and join a team of other advisors as a junior person. So your choice. If you are, really anxious, ready to get going, sure, you can become a client-facing, client-serving advisor very quickly, or you can go the career path and take your time learning as an apprenticeship environment over a number of years. Up to you.
Right. Right. And then, so when you're in that scenario, just starting out in your career, let's say you're under someone, under a mentorship, you're learning, and you're getting to a point where you're able to start, you've talked to like, let's say an individual client multiple times. How do you portray as a young person, how do you get them to trust you to potentially, be their manager one day, or just to trust you probably in that scenario as assistant advisor?
When you say you've had a number of conversations with a client, I think you meant prospect.
Yes, sure, yep.
Meaning someone is not yet a client and you're trying to persuade them to become a client.
Yeah.
So it's a three-stage process, just for clarity of definition: suspect, prospect, client. A suspect is somebody you think has potential. A prospect is someone you have checked out, you've had a conversation with, you've checked them out online or what have you, and you have confirmed that they are good quality material to be a client. And then when you have them sign the new account paperwork, that's when the prospect becomes a client. Everybody's a suspect, right? Everybody in the world.
Right.
And you've got to filter them to determine which of those are actually legitimate candidates for becoming a client, and that becomes the prospect pool. They're prospective clients. And it's important to understand how you filter this, because that's going to lead to the answer to your question of persuading them to hire you. You have to decide before you begin the suspect evaluation who it is you want to serve. Do you want to serve? And I would recommend that you don't do it the way I did it. The way I did it back in the 80s was an environment and a model I invented that was unique at the time, highly innovative, incredibly successful, but it really doesn't exist today. What I did essentially was broadcasting, and I'll explain why I did it and how I define it in a moment. The bottom line is I was 28 years old, brand new in the business, had no social network where Gene and I lived. We were living in the Washington, D.C. area. Neither of us went to school there. We didn't have any family there, and we didn't grow up there. So we knew nobody in the D.C. area. And 28 years old, we were young and dumb, and didn't have any money ourselves and didn't know any people with or without money. So how do I persuade total strangers to hire me? Well, first of all, I had to meet these total strangers. How do I meet these folks? The world of social media did not exist. Cell phones had not yet been invented. So how do I meet them? And how do I, after I meet them, persuade them that I'm worthy of them to hire me? First, I had to evaluate what my attributes were. What's the legitimate justification I can offer to demonstrate why I was worthy of being hired, as opposed to them hiring somebody else? Fortunately, at age 28, I had already spent several years as a writer and editor in the financial industry. So I had that credibility as a participant in the marketplace. I wasn't just straight out of college with nothing but classroom and book knowledge. That was helpful. I also wasn't aligned with a firm. I therefore didn't suffer the conflicts of interest. When you go to a lot of firms, the investment recommendations they give their clients are the products they themselves are recommending and inventing because they make a lot of money selling those products. I didn't have that conflict of interest. That independence was uncommon, and that was something I could use to sell against Merrill Lynch and Payne Weber and the big brokerage firms and so on. So those were my primary attributes. I also took a disadvantage and turned that into an advantage by saying to a client, look, I'm new in this industry and I'm determined to prove myself. And I don't have hundreds of clients, which means I'm going to spend an awful lot of time and attention on you, taking care of you and serving you. And that kind of warm fuzzy, help me out, I'm young. You can have a material impact on my life while I'm having one on yours. And I don't have conflicts of interest of serving a whole bunch of other people. I am going to focus my energy on you and your benefit. So you take a negative, you turn it into a positive. But I still had the challenge of meeting people to even have that conversation. And what I quickly realized was the best path was to do seminars. Choose a topic that I know a lot of people are interested in, invite them to this event. Now I can demonstrate over a 30 or 60-minute interval my knowledge and expertise, showing them I know what I'm talking about. Knowing that some in the audience are going to express interest in further conversation with me where I can make my pitch to becoming their advisor. So that's how we built our business, by doing educational seminars. And then to broaden our exposure to the marketplace, we turned literally to broadcasting, and I started appearing on radio. And I ended up hosting what became the nation's longest running personal finance radio show. It aired for 32 years in 100 markets around the country. I had 500,000 listeners each week. Was named one of the 100 top most important talk radio hosts in the country. That led to television, where I ended up not only being interviewed everywhere, but hosting my own TV shows over decades. I was on Oprah 5 times, been on every major news network. That led to people saying, what book should I read? So I've ultimately written 13 books. I'm working on number 14 right now. And so you put yourself in a position through broadcast media so that large numbers of people can see you, get exposed to you, and see that you have a level of knowledge, expertise. And that can entice some of them to say, that's a person I want to talk to about hiring. That broadcast marketplace worked very well for me back in the 1980s and 90s, but that model no longer exists. Partly because of compliance, partly because the marketplace has radically changed due to social media. I was the only guy on the radio in this country when I invented that. I was the first advisor to do this. Now, everybody can have their own social media platform. You know, there are millions of podcasts. Mine was in the top 1% before I stopped it at the end of 24. But everybody can do this. Look at yours, Brandon. You're doing a podcast. And so getting people to tune into your podcast is really difficult. How do you get through the noise and clutter and help people learn of yours and get them to pay attention to it? So rather than trying to build your business the way that I did it, even though it was hugely successful for Gene and me, we broadcast. We didn't know who of those 500,000 people were who were listening to radio. And therefore, when they came, we would serve whoever they were. And we had rich people, poor people, old people, young people, every occupation you can imagine, every geography in the country. We're happy to serve them all. That's what you do with broadcasting. I wouldn't recommend that for you or others who are starting out new. I would instead recommend that you narrowcast, meaning at the suspect level, choose, before you filter the suspects into prospects, choose the kind of client you want to serve and who is likely to be willing to be served by you. I don't think you ought to waste your time calling Elon Musk or Mark Cuban. I don't think billionaires are going to want to waste their time talking to you and letting you manage some of their money. You don't have the skill set or expertise that they need. Besides, they already have legions of advisors that are serving them. You'd be in massive competition with all of those folks. Not worth your time and effort. But there's a huge number of categories. Do you want to serve young, middle age, older age, elders? Do you want to serve individuals or married couples? Do you want to serve families? Do you want to serve people who don't have money but aspire to? Do you want to serve people with a little bit of money and are trying to become wealthier? Do you want to serve the mass affluent? Do you want to serve high net worth? Do you want to serve the ultra high net worth? Do you want to serve family office? Do you want to serve institutions? And if so, what kinds of institutions? Pension funds? What size? Small little mom and pop charities, or the largest charities in America, like the American Red Cross? Do you want to serve college and university endowments? Do you want to serve sovereign wealth funds? What kind of institution do you want to serve? What kind of services do you want to provide? Do you want to focus on the money management? Do you want to focus on holistic financial planning? Do you want to focus on estate planning? Do you want to focus on tax planning, philanthropic planning? What kind of services do you enjoy? What psychographic do you like? What hobbies do you enjoy? If you are into auto racing, then you ought to want to target people who are auto racing enthusiasts. You like fishing? You like bowling? Do you like knitting and weaving? Do you like travel? Do you like food? What is it you like to do? I'm sure you'd like to hang out with people who like to do the same thing, who, by the way, can become clients. So decide who it is you want to serve. That becomes your filter, and only serve those people. I know one advisor whose office is across the street from Marriott's world headquarters, and he will only serve executives of Marriott. If you're not an executive of Marriott, he won't take you as a client. He knows more about Marriott's executive compensation program than anybody, and he gives great advice on how they ought to handle their stock option program, their executive deferred comp plan, on and on and on. I know another advisor who only serves pilots of Delta Airlines. You're not a pilot? In fact, you're not a pilot of Delta? Well, he won't help you. So you say to yourself, on the one hand, gee, if all you're going to do is serve this incredibly narrow niche, you're really limiting yourself. You're going to turn away business. Yeah, but on the other hand, how many clients are you really trying to manage? Most advisors have 100 to 200 clients. That's their capacity. Well, how many executives are there at Marriott? How many of them do you need to get in order to have a successful practice of 100 to 200? I mean, how many fishermen are there in this country? The number one hobby sport, by the way, in the nation. So choose the kind of practice you want to have, who it is you want to serve, and then really focus on them. If you want to serve plumbers, and nothing but plumbers, you grew up in a plumbing household. Your dad's a plumber, your uncle's a plumber, your grandmother manufactures plumbing tools. Plumbing's in your blood. Become the financial advisor to plumbers. Now you go to the plumbers convention. You'll be the only financial advisor there. You write for an article on financial planning for plumbers magazines. You become really well known in the plumbing community. You'll be incredibly famous in the plumbing world. No one else will ever heard of you, but you'll be the guy in that environment. Narrowcast, I think, is a much better approach for building your business. If I were starting out brand new, I would not broadcast like I did in the 80s and 90s. Today, I would narrowcast.
Great. Yeah, that's awesome advice. I want to jump to this because I want to make sure we have time about this conversation, because I know listening to your podcast and reading your articles and whatnot, I know this topic you've spent a lot of time on. So, and that's cryptocurrency. So cryptocurrency specifically being an asset class that individuals should have as a part of their portfolio. So obviously, it's all that pros and cons. There can be a lot of controversy depending on who you're talking to with cryptocurrency. Some, it seems like, it's the future. Some are waste your time, don't spend any time investing in it. So how can young wealth managers, approach crypto in client portfolios who desire to invest in crypto themselves while still maintaining those key principles of diversification and risk tolerance?
I've been in the crypto space since 2012. I recognized pretty quickly two things. First, Bitcoin and more broadly blockchain technology is a transformative technology that will prove to be as profound as the internet. In fact, many refer to blockchain technology as Internet 3.0. The original internet we now refer to, Internet 1.0, was the internet of people. The internet connected us. Think Facebook, social media, YouTube, email, texting. This is all thanks to the internet, and it allowed us to connect with each other. So the internet of people. Internet 2.0 was the internet of things. That's where Bluetooth comes into play, where you're talking to Alexa, or your phone is talking to your car. Your coffee pot is automatically connected to the internet, and you press a button and it brews coffee when you've woken up. That's the Internet of Things. And everything over the next decade is going to get its own QR code being connected to the internet. Your next gen refrigerator will tell you when you're out of milk, and then it'll automatically order the milk for you, and Amazon will deliver it without you having to do anything. That's the Internet of Things. That's Internet 2.0, and it's in place today. The next gen of internet is Internet 3.0. That is the Internet of Money. It is the opportunity for us to transmit, store, and earn money using the internet. Think about this with Facebook or Instagram or Snapchat, or pick your social media site. You are uploading your data, right? You're opening an account, you're providing your information, you're uploading photos, you're engaging in conversation with your networks. You're doing all of this for free. Meta, Mark Zuckerberg, owns the data you upload to Facebook. I'm astonished that so many people of your generation and mine are that stupid. Why are you giving away all of your data to Mark Zuckerberg so that he can be one of the 5 wealthiest people in the world? This is dumb. Wouldn't it be smarter to license the data to Facebook? To say, I'll upload my data to you, but when you sell that data to advertisers, I want a cut of the action. That's blockchain technology. With blockchain technology, an artist can post an image, a painting, or create a digital image, post it onto, say, OpenSea, and somebody can buy it, generating revenue for the artist. And when the buyer resells it to another buyer, the artist gets a commission for having done so, providing a lifetime income for the artist, the same way recording artists get lifetime income every time the song is played on Spotify. This is the Internet of Money. The ability to move money from me to you over the internet instantaneously, for free, highly secure, with no intermediary, such as a bank or brokerage firm, in between the transaction collecting a fee. This is blockchain technology. This is transformative for commerce on a global scale, and that is why there's so much excitement about it. So I realized all this in 2012, 2013. This is a big deal. But I also realized that the financial services industry doesn't get it, because blockchain was invented outside of the industry. So the industry was not involved. Nobody knows who invented it. Somebody named Satoshi Nakamoto. We don't know who that is. Satoshi made it free, uploaded it, gave it away at no cost to the world. And so here we are today, a $3 trillion asset class that Satoshi handed us all. So I created in 2015 DACFP, the Digital Assets Council of Financial Professionals, dacfp.com, as a crypto education company to teach advisors and their firms about this technology, to understand it, figure out how to incorporate it into your practice, and how to engage with it from an investment management perspective, portfolio allocation, how do you invest, how much do you invest, which of your clients ought to invest, etc. I can tell you over the past 15 years that I've been involved in this space, almost 15 now, that we've come a long way. There was a lot of legitimate questions in the early days. Is this real? Is it a fad? Is it a fraud? Is it going to survive and thrive, or will it vanish and go away like so many other fads and frauds? Nobody's asking those questions anymore. When you say that it's controversial, the only people for whom it is controversial are people who have not studied the technology. End of story. I have met an awful lot of people who used to be crypto haters, who then studied it and are now deeply engaged in crypto. I know an awful lot of billionaires who worked in TradFi, traditional finance, ran some of the largest Wall Street firms, and left Wall Street to get into crypto. I have never met anybody in crypto leave crypto to go back to Wall Street. And now the largest Wall Street firms themselves are all engaging in crypto. BlackRock, Fidelity, State Street, Invesco, Franklin Templeton, Global X. The list goes on and on and on of the biggest asset managers in the world offering crypto products, managing assets in crypto, developing crypto applications. One of the funniest examples of this is JP Morgan. Jamie Dimon, the CEO of JP Morgan, publicly says that he thinks Bitcoin is worthless. And yet JP Morgan operates their own blockchain where they transact $2 billion a day in cross-border transmittals. His own bank does this, while he says this is nonsense technology. So we need to recognize that if you are a skeptic, if you're afraid of it, the volatility, you've heard about volatility, you've heard about fraud, you've heard about and bad for the environment, you've heard whatever it is you've heard, and you're afraid of it or skeptical of it, or you hate it because of those concerns, good. That's the basis of the learning of knowledge. You need to go prove your theory. Just because you've heard Bitcoin is blank, prove it. Go study it yourself. Jump down that rabbit hole and explore. Read my book, The Truth About Crypto, #1 Amazon bestseller, which I wrote in 2017. A little bit out of date, but it's still 95% valid. Listen to podcasts on crypto. Look at the products that are available. The biggest asset managers in the world now operate Bitcoin ETFs, Ethereum ETFs. There are crypto picks and shovels ETFs. There are separately managed accounts in the world of crypto. There are hedge funds in crypto. Institutions and endowments, billionaires, governments are all investing in crypto. Do you know the United States was one of the 5 largest owners of Bitcoin in the world? The United States government. So you need to get past your assumptions, your biases, your preconceived notions. That's not what a financial professional does. A financial professional studies, analyzes, evaluates, and reaches your own independent conclusion. And if your conclusion after all of that is that I'm not going to invest, fine. But don't do it out of, oh, I heard this or I believe that, because what you think, what you've heard is probably nonsense. Just last week, I released a new white paper called The 6 Common Misbeliefs That Are Preventing You from Buying Bitcoin. People today are still operating under misconceptions that are holding them back for all the wrong reasons. So read my white paper. It's at dacfp.com, dacfp.com, and read the white paper and see if it challenges some of your current beliefs, and use it as an opportunity to learn a lot more. Having said all that, let's talk specifically about the 2 points you raised, Brandon, because they are right on point: volatility and diversification. As a business school student, I would hope you're familiar with MPT, Modern Portfolio Theory. Is that a yes?
Yes, I believe so. Yes.
Modern Portfolio Theory was developed by Harry Markowitz. I had the pleasure of knowing Harry before he passed. He's probably the most influential individual in the field of investment management today. Harry was a graduate student at the University of Chicago in 1952. And in that era, he developed modern portfolio theory. He got a C on his grad paper when he wrote it. His grad mentor said, this dumb paper doesn't make any sense. That was 1951. That paper eventually won Harry the Nobel Prize in 1991. It took a long time for Wall Street to realize Harry was a genius and what he was saying was incredibly important. What Harry said is something that you understand today will be, as I cite it for you, will be incredibly obvious to you, and you'll be astonished that it could win the Nobel Prize because it's so obvious. And here's the statement that Harry made in 1951. Investing is as much about risk as it is about reward. Doesn't that strike you as obvious?
Yeah.
That statement was profound in the 1950s and 60s, ignored until the 90s. Because until then, for hundreds of years, you would argue thousands of years through human history, investing was entirely about profit. Where can I invest in order to make money? In fact, where can I invest to make money, more money than I'd make from making some other investment? What we call opportunity cost today. If I buy A, I deny myself the ability to buy B because I took my money and used it on A. So I want to buy A instead of B if A is better than B. If A is not better than B, I want to buy B. But now I got to look at C, D, E, and F. So opportunity cost, choosing where to invest my money is what it's all about. And making more money than you, because we're keeping score, matters. I want to make more money as fast as I can. The notion of managing risk was unheard of, truly unheard of, until Harry came along. And Harry said, wait a minute, maybe we ought to pay attention to risk as much as return. Let me give you the analogy that I like to use. You get in an Uber to go from here to there, and you say to the driver, how long is this going to take? And you look on the app and you talk to the driver, and it says it's going to take you 20 minutes to get there. And you're like, cool, no problem. You take the ride. A couple of weeks later, you do it again. You get in a different Uber with a different driver. And instead of it taking 20 minutes, he gets you there in 7 minutes by driving incredibly fast and recklessly, blowing through stop signs and red lights, driving on the wrong side of the road, cutting off other people. Are you going to reward him for the performance or penalize him for the risk?
Penalize.
Well, this is a point of view, isn't it? Some people would reward. My goal is to make as much money as I can. I don't care how much risk I took to get there. I want to double my money. If you double it for me, great. I don't care if you made me take risks. Other people like you, most people like you, would say, I care about the risk I'm taking. I'd rather ride a Ferris wheel than a roller coaster. If you think about it, they both end up at the same place, right where you started. But one of them made you go on a wild ride. So this is a personal perspective and a personal choice. Do you want to maximize your returns, or do you want to optimize your returns? Take as much risk as needed relative to the returns you're trying to obtain. This Harry called the efficient frontier, and others such as William Sharp, who created the Sharp ratio, and Gary Brinson, very famous for the Brinson study. All this research helped us realize we can improve our results on a risk-return basis through portfolio optimization. Meaning, if I have all my money in a single investment, I'm taking a big risk, right? All my eggs in one basket. Better not drop that basket, right? But what if I buy 12 eggs and I put them in 12 different baskets? So what if one of the baskets breaks? I still have 11 left. And this is why we all believe in diversification. Harry taught us this. Harry also taught us something else that was fascinating to this. If I'm going to have 12 different eggs in 12 different baskets, one of those eggs can be extraordinarily risky. It's going to be incredibly volatile. But here's what we discover. Adding a risky asset to a portfolio lowers the overall risk of the portfolio. It's counterintuitive. If you've got a diversified portfolio and you add stocks to it, stocks are riskier than bonds, the overall portfolio becomes safer than if it only owned bonds in the first place. Because we know that stocks, yeah, they're volatile, but they go up and down differently from bonds. So at the very moment that stocks are falling, bonds are probably rising. And that helps to reduce the impact of the decline of stocks. We know this about diversification. This is why we diversify. It helps to reduce our overall risks. Even though an individual asset might be risky, its impact on the overall portfolio isn't as severe. And the only way diversification works is by buying assets that are volatile. Right? If your money was entirely in bank CDs, zero volatility, owning 10 CDs isn't helping compared to owning just one CD because they're all the same. There's no volatility. If I have 9 CDs and one stock, now I'm improving my returns. And that's why we add into our portfolio volatile assets, stocks, bonds, government securities, real estate, oil, gold, commodities, foreign assets, because we know that these different assets, although each of them are volatile in their own way, they're volatile at different times. And we end up with a reasonable amount of volatility, but above average returns, which is better than not having done it at all. All that making sense, Brandon?
Yes.
Therefore, what we want to make the portfolio work best is to make sure we own volatile assets. You agree with that statement?
Yeah.
Then wouldn't it make sense that we want to own the most volatile of all assets?
Guess it depends who you're talking to.
We'll get to that question in a second. If you believe in diversification and you understand the role of volatility, you want volatile assets, and the more volatile they are, the better they perform because of your rebalancing of the portfolio. And that is why adding Bitcoin to a portfolio improves the overall risk-reward metrics of the portfolio. Meaning, if you look at the Sharpe ratio, the Sortino ratio, standard deviation, and all of those MPT numbers improve when the portfolio owns a very small amount of Bitcoin. When I say small, I mean 1 or 2 or 3%, maybe up to 5%. We don't need to put 50% into Bitcoin, but a low single-digit allocation improves the returns because Bitcoin is an outperforming asset class, but it also lowers the overall risk of the portfolio thanks to diversification, dollar cost averaging, tax loss harvesting, and portfolio rebalancing. This is why most advisors, most in the financial industry, are excited about Bitcoin because it improves portfolio management. But then we get to your question, which is key. And that question, Brandon, says to me, you're acting more like a financial planner than a money manager. Because the money manager would say, Bitcoin makes perfect sense. But the financial planner says, but can my client handle that volatility? Because if the client can't handle the roller coaster, they'll simply sell when it's low. They won't enjoy the high because of the risk. And this is the key question all advisors must answer. Is my client going to be able to tolerate the volatility that this asset by itself has? This is why you need to have a detailed and extensive conversation with your client to help them understand Bitcoin and crypto in general, to understand its role in a diversified portfolio, to confirm for them their agreement that they believe in diversification and long-term investing with rebalancing. If they don't agree to that, and if you don't remind them of it on a regular ongoing basis because they're going to forget, then you're right. You shouldn't have volatile assets in that client's portfolio. But for most clients, they would agree, yes, they agree with diversification. Yes, they are investing for the long term, meaning years and decades, not days and weeks, months. That they understand how portfolio rebalancing helps to smooth out volatility. And they're willing to sign on to a diversified portfolio that contains a little bit of Bitcoin. But it's your job as the advisor to confirm that fact, and then to revisit with the client frequently to verify the client is still okay with all that, especially during periods when Bitcoin is falling, because it is a very, very volatile asset.
Great. Yes, thank you. And going to one of your points, and this is one of the greatest advice that I've learned from you listening to your podcast, and just kind of growing up, being attentive to the news, is not basing opinions on headlines. Like if a headline says crypto is bad, and now I think crypto is bad just because of a headline, doing your own research and finding what you truly believe based on the time and research that you as an individual puts in. You won't have a definite answer by someone saying something to you or a headline. You have to learn it for yourself. And I think that's extremely important and hard to do when you're a kid. But it's something that is great advice, and we should all try to get better at that every day.
I'm glad you cited that, Brandon. It's what professionals do. It's how professionals behave. It's very easy to have a 30-second soundbite that bashes anything, anybody. You know, it's easy to say that restaurant's terrible. It's a lot harder to prove them wrong, because now, although they said it in 10 seconds, that restaurant's terrible, now you have to spend a whole evening at the restaurant proving that they're wrong. And do you really want to go to the trouble of doing that when there are other restaurants to go to instead? So it takes a lot of effort to say, I'm going to independently verify that argument, and I'm going to confirm for myself whether that's true or false. Too often, people in our industry simply repeat what they're told, or they do what they're told, and they don't engage in their own research. In fact, that's one of the phrases in crypto, DYOR. Is a phrase you'll come upon. Do your own research. Because too many people are simply repeating the myths and the misconceptions and the falsehoods that are recited by others. In fact, some of the things people say as a negative today, they're not true today, but they were true 10 years ago. And people are still reciting stuff that's 10 years old that is out of date and no longer valid, but they don't know it because they haven't studied it or they haven't kept up with it. So you're absolutely right. To investigate this on your own and to evaluate whether or not this is legitimate and whether it's something you ought to be paying attention to. Do your own research. That's all I ask.
Right. I think that's a great spot to end. It was a real treat to have you on our Wealth Management podcast. I appreciate you giving us your time.
It's been my pleasure, Brandon. I wish you and your fellow students the very best.
Thank you.
If you enjoyed the discussion, please like and share the podcast on Apple and Spotify. The Spartan Journal podcast is part of Michigan State University's Wealth Management Association, a student organization whose goal is to inspire the next generation of financial advisors. The Spartan Journal news team releases a newsletter every Monday morning comprised of financial literacy and the week's market updates. Feel free to follow us on social media at msuwma, and check out our website at msuwma.com. Anything heard on either the MSUWMA or Spartan Journal podcasts is for educational purposes only and should not be considered as investment advice.